The yield curve is a graphical representation that shows the relationship between interest rates and the maturity dates of government bonds, typically U.S. Treasury securities. It plots yields on the vertical axis and the length of time until maturity on the horizontal axis. The shape of the yield curve offers valuable insights into investor expectations about economic growth and inflation. When the curve is upward sloping, it suggests optimism about future economic conditions. Conversely, a flat or inverted yield curve can signal concerns about slowing growth or a potential recession. Because of its predictive power, economists and investors closely monitor the yield curve as a crucial indicator of the economy's future direction. The yield curve has long been recognized as a valuable indicator of economic trends, particularly in forecasting recessions and periods of growth. When the yield curve inverts, meaning short-term interest rates exceed long-term rates, it has often preceded economic downturns. Notably, an inverted yield curve was observed before the recessions of 1981, 1990, 2001, and the global financial crisis of 2008. In each case, this signal appeared months before the broader economy began to contract. Economists and policymakers closely monitor the yield curve because its shape reflects investor sentiment about future economic conditions. A steep, upward-sloping curve typically suggests optimism and expectations of growth, while a flat or inverted curve raises caution about potential slowdowns. Over the decades, the yield curve's predictive power has made it a central tool in economic analysis and decision-making. The yield curve, which plots interest rates across different maturities, serves as a key indicator for the economy. When the yield curve steepens, long-term borrowing costs typically rise, making mortgages and business loans more expensive. This can lead individuals to delay major purchases, while businesses may postpone investments or expansion plans. Conversely, a flattening or inverted yield curve often signals economic uncertainty, potentially lowering borrowing costs, but also dampening market sentiment. Investors closely watch these shifts as they can influence portfolio strategies and risk assessments. Overall, changes in the yield curve ripple through financial markets, affecting decisions at both the personal and corporate level. Understanding the yield curve can provide valuable insights into the overall health of the economy and potential shifts in interest rates. A normal, upward-sloping yield curve often signals economic growth, while an inverted curve may indicate a possible recession ahead. By monitoring changes in the yield curve, investors and consumers can better anticipate shifts in borrowing costs, investment opportunities, and economic trends. When interpreting the yield curve, it's important to consider other economic indicators and not rely solely on its shape. Using this information thoughtfully can help you make more informed decisions about saving, investing, and managing debt, ultimately supporting a more secure financial future.